Hi, Nick Vanderkar here, selling the main line with Low & Foster Real Estate. I have with me today Michael Graff from Prosperity Home Mortgage, our mortgage contact here at Low & Foster in Devon. And I thought I'd throw a couple of questions at Michael regarding ARMs and who should use those and whether they are actually a good idea, bad idea, or something that everybody should just forget completely. But I don't think he's going to say that. So, thanks for being with us today, Mike.
So what's an ARM? An ARM is a loan product where the interest rate is fixed for a certain amount of time. So it's different than your 30-year fixed conventional mortgage. An ARM could be a 5, 7, 10, even a 15-year fixed. So what that means is the rate is fixed for a certain amount of time, and after that period of time, the rate can adjust up or down. So for an example, let's take a 5-year ARM. So a 5-year ARM, typically the rate might be about a point lower than a normal 30-year fix. So you can see an advantage there. It's a point lower in interest rate.
And Mike, when you say a point, what is a point?
So 1 percentage point. So to give an example of today's going rates 4 1/4, a 5-year ARM might be 3.25. So it's a full point lower.
Great.
So obviously that's an advantage there. The big misnomer about, I guess, ARMs is it's kind of scary to some people, thinking, well, after the 5 years, the rate's going to shoot up to 20%, and what am I going to do? So typically ARMs, they all have a cap. So there's the most they can raise each year, which is typically 2%. So if the first year, or the first 5 years, excuse me, is 3.25, the worst it could be year 6 would be 5.25, which is 2%. Now what's interesting is the average time someone holds a loan is 6.5 years. So you can see where the advantages of having an ARM is the fact that typically no one holds a loan for 30 years. Yet everyone wants a 30-year fixed, and they pay a premium for the interest rate on a 30-year fixed, yet no one ever holds the loan for 30 years. So a lot of people like to get that savings, in a 5, 7, or 10-year ARM, where you might be saving, 10, 20, even $40,000 over that period, just in interest for the lower interest rate, full well knowing that in 7 years from now they're not going to be in that house. They're going to be relocating or for whatever, upsizing, downsizing, whatever the reason may be. There's an advantage of saving that money in that short term, 5, 7, 10 years, as opposed to paying that 30-year premium rate for a fixed mortgage.
And Mike, is there usually a top cap that the rate can go to?
For the maximum loan,
maximum.
Yes. Typically it's 5% above the initial start rate.
So if it's 3, it would go to 8.
Correct.
Okay.
Correct. And the most important thing is you're never locked into the loan. So there's never a prepayment penalty with any of the loans, so that you can refinance, pay extra principal, do whatever you want, whenever you want. There's no restrictions at all.
Okay, that's great. Thanks very much.
Thank you.
And thanks for your help today.
Thanks.